This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pashurdis. Thanks for joining us at XM.com. Financial markets have turned into one gigantic war trade in recent weeks. Politics has eclipsed economics, with most assets driven entirely by the conflict in Ukraine. This phenomenon is on full display today after negotiators on both sides signaled progress in the latest peace talks and kept the door open for a ceasefire soon. With the pendulum swinging towards peace, traders are cautiously taking on risk again, increasing their exposure to European assets. The euro and stock markets in the region are flashing green today, although the gains are rather minor as nobody wants to bet the house on a relief rally while the war continues to rage. In contrast, safe havens and war-sensitive commodities are on the retreat. Gold prices, the Japanese yen, sovereign bonds, and crude oil have taken a hit as investors take some profits off the table. The yen has been hit particularly hard, sinking to a fresh 5-year low against the dollar thanks to the divergence between American and Japanese monetary policy. There are several reasons this war is so important for markets, but the primary one is inflation. The crippling sanctions on Moscow will likely translate into higher prices for raw materials like metals, food, and energy, which in turn is expected to keep inflationary fire burning for a long time. Metrics of inflation expectations have gone through the roof lately, leaving central banks little choice but to raise interest rates, even if that means accepting a higher risk of recession. With major cities in China descending back into lockdowns over the weekend, the supply chain could also remain under strain. The peace talks are expected to resume today, and any more signs of de-escalation could add fuel to the latest reversals in war trades. The Federal Reserve and the Bank of England are both set to raise interest rates this week to combat spiraling prices. This would be the first time the Fed raises rates this cycle, and with the rate hike itself already baked in, the market reaction will depend on the updated dot plot and what Chairman Powell says. The latest dot plot pointed to 3 rate increases for this year, but market pricing currently implies 7, so it's almost certain the dots will be revised higher. The question is exactly how much higher. This was today's Daily Market Comment. Thanks for joining us at XM.com.